you're getting Japanese companies that are returning cash to shareholders, and you're getting more M&A activity. You're despite the fact that they're returning cash to shareholders, cash still continues to build up on balance sheets. So when you ask, what are we focusing on? We're focusing on those companies that have the greatest ability to return cash to us as shareholders. So those companies below book value who have the greatest opportunity to increase their returns on capital above their cost of capital.
Hey guys, welcome to Everyday Finance, the changing trajectory of interest rates, the crucial role of liquidity in propelling market cycles, and current asset valuations across sectors are just a few of the major macroeconomic trends that Raoul Pal and Mark Heschmeyer discussed recently. They pointed out that these elements are becoming more interrelated and that both institutional and individual investors must comprehend their effects in order to successfully navigate the complicated markets of today. Robotics, which they view as a high-growth industry positioned to profit from growing automation, labor shortages, and advances in artificial intelligence, was one area they highlighted as being especially promising. Robotics stands out as a defensive and forward-thinking investment, as conventional economic models are disrupted. They also emphasize the necessity of building a balanced portfolio, highlighting the importance of having exposure to both growth and value stocks during a period of volatility and macro uncertainty. They contended that diversification is about positioning oneself to profit from a variety of market conditions, not just managing risk. Their observations offer a useful prism through which to examine the changing dynamics that are anticipated to affect capital flows and investor behavior in 2025 and beyond. Take a listen to Raoul Pal.
My working hypothesis on that came up at a Global Macro Investor Roundtable last year, is that the game theory suggests that there can't be a conflict, because it's too catastrophic, not only from the kinetic war thing, but TSMC.
Yeah.
Right now with AGI, at the dawn of AGI, this is far too important for everybody.
Including
really
China.
The answer's got to be what the UK kind of did with Hong Kong and the US, and everybody needs to say, look, you can have Taiwan, but the 3 TSMC plants in Arizona need to get built, the one in Germany, the one in Japan, and everyone kind of just goes their own way quietly.
Yeah, I agree with that. I mean, China does not have an aggressive history. I would, argue, I'm not an American and I love America. It's the greatest country in the world, but, America has more of an aggressive international policy than the Chinese do. And America's been more active militarily overseas than the Chinese have. And so, my belief is that the Chinese won't attack it militarily, but that is a risk. But I do agree with you. I mean, 100% of, or 90% of all of the most advanced chips in the world are produced in Taiwan. And, but it, and you got to believe that if the Chinese invade Taiwan, that those facilities won't be scuttled to some extent. There's no way in the world you could have the Chinese control, over 90% of the advanced chip production in the world. So, but that would be very detrimental to the Chinese as well. I mean, it's detrimental to the world. And if that happened and the world went into, some sort of depression because we didn't have chips anywhere, that's incredibly bad for the Chinese as well. And, I think the Chinese really need to get their economy growing. They need stability in their economy, and they need that to control the place politically. So logic tells me that it doesn't make any sense for them to invade, and there needs to be a political solution. But if the political solution is what you've just recommended, then all these manufacturers of chip facilities must be incredible buys, because we have to duplicate that capacity around the world. Now, we started it to a certain extent, but we're nowhere near where it needs to be. And it's going to take, 3 to 6 years to get that done.
Yeah, I don't see another solution. So it just kind of feels like the obvious trade, because anything else is so suboptimal for the world that we don't go there. And what kind of opportunities are you seeing in Japan? Is that on the kind of industrial manufacturing side, or is it, what are you seeing there in Japan?
Well, it's one of the few or only countries in the world where the stock exchange itself is acting like an agitating shareholder. So basically, the stock exchange is mandated that companies trading below book value have to show how they're going to get their returns on capital up above their cost of capital, or they're going to be delisted. And we went through a process at the end of last year where they actually did that. They started delisting companies. And so you have the stock exchange itself agitating for change, which is really quite amazing. You have something like 40% of all companies in Japan trading below book value. And despite the fact that that the market hasn't done well, people don't realize that over the last 15 years, earnings growth in Japan has actually been better than earnings growth in America. And it's just because the multiples have contracted and also the currency's weakened that your returns have been much lower. But because of this agitation that's going on, you're getting Japanese companies that are returning cash to shareholders, and you're getting more M&A activity. You're despite the fact that they're returning cash to shareholders, cash still continues to build up on balance sheets. So when you ask, what are we focusing on? We're focusing on those companies that have the greatest ability to return cash to us as shareholders. So those companies below book value who have the greatest opportunity to increase their returns on capital above their cost of capital. And, we just bought a whole basket of stocks in Japan where they have leased assets on there. A lot of companies there have excess real estate, and a lot of the real estate they don't use for manufacturing or service facilities. And as a result, they lease it out. It's not booked properly and not looked at properly when people value the companies. And if you looked at some of these companies, the lease assets in their portfolios is 70 or 80% of the stock price. And these are assets that could be spun out at some point in time. So you basically have this massive change in Japan in a country where earnings have been doing well, returns on capital have been improving. And you got the stock exchange itself agitating for change. And it's a lot of domestic companies as opposed to a lot of export companies. But it's very eclectic. It's basically companies that are cheap relative to book, companies that are cheap relative to assets on property, properly reflected on their balance sheets, where there's agitation for change.
A combination of robust technical indicators and a noticeable change in market sentiment suggests that Bitcoin is poised for yet another significant rally this year. The price action of Bitcoin has been closely monitored by analysts, and recent events point to a possible breakout from a bullish falling flag pattern, a traditional chart formation that indicates the continuation of an upward trend. This technical configuration is consistent with rising optimism in institutional and retail circles. Bitwise CIO Matt Hoogan recently pointed to a significant increase in institutional confidence, pointing out that professional investors' portfolio allocations to cryptocurrency have increased dramatically, going from a cautious 1% to a more assertive 3% to 5%. This change indicates that Bitcoin is becoming more widely recognized as a valid asset class and a way to protect against conventional market risk. Prominent investors who have increased their exposure to Bitcoin, such as Kevin O'Leary, have contributed to the bullish momentum by pointing to improved regulatory clarity and robust returns. In terms of geopolitics, the reduction of tariff tensions by former President Trump has given international markets hope, and the cryptocurrency industry has benefited from this as well. Meanwhile, there has been a noticeable increase in inflows into Bitcoin ETFs, indicating that Wall Street is once again becoming more receptive to digital assets. Whale activity, which is usually regarded as a sign of significant price movements, has also increased, as evidenced by large, calculated Bitcoin purchases. The most startling is probably the increasing speculation that the White House may consider selling off some of the nation's gold reserves in order to purchase Bitcoin. This would be a strategic and symbolic move that, if it were to happen, would signal a radical change in how the government views digital currencies. When combined, these events show growing confidence in Bitcoin's long-term worth and a situation that may spark a strong, long-lasting rally. Watch the clips.
And
And
is it realizable value? Does the market actually reprice these things, or does it
absolutely,
remain? cheap.
Yeah, absolutely. I think we're investing in a company today where they have a plan to distribute 350 million of capital back to shareholders. If they don't do that, the entire market cap of the company will be covered by net cash in 3 years. And this is a company that's making money and selling products around the world to a lot of different manufacturers. And they have a plan to do this. And even when they do this, they'll still have, and that's about 60% of the market cap of the company. So because of the distributions that are being made and the share buybacks that are being made, and the amount of shareholders that are going in and demanding change in Japan, yeah, these are very investable companies with real catalysts and real change that are occurring. And it's very exciting. I think it's one of the most interesting non-US markets in the world today.
And it's also the right time in the cycle as well. As global growth starts finally to pick up again, Japan usually is the outperformer from the cyclicality perspective as well.
And you have an incredibly weak currency as well. I mean, incredibly weak currency. Now you've got a lot of issues in Japan. The biggest probably, which would be debt, particularly government debt. But you do have cheap currency, cheap assets, and a lot of big change that's going on. And so it's a fantastic market. When I used to go to Japan in the 80s and late 80s, if you asked somebody what their cost of capital was, first of all, they wouldn't even know what cost of capital was, much less what it was for themselves. And today, the emphasis on return on capital and understanding what your return on capital is and your cost of capital is, it seems basic, but it's a big driving force in Japan.
How much of a basket case is Europe? Because this is the age-old value trap, right? Europe's been a pig of a trade for a while. How are you thinking through this one?
I just came back from London, what's today, Thursday, so Monday, I guess I came back. And, it was interesting to see that market come down with Brexit and then come down again with COVID. And then it got down to, unbelievably cheap levels. If you want to know about the problems with Europe, you just have to need the Draghi report. I think it was an interesting report, but I don't think he said anything there that none of us don't know. There's too many regulations. I tried once to buy a small piece of land in Italy. Just getting your documents notarized in Italy is just an unbelievable process. It takes 10 minutes in the Caymans or in the Bahamas where you just go into a lawyer's office and you notarize it. In Italy, you have to get the document in Italian and in English. You go to a notary office, which is a government office. They read every single page in Italian, then they read every single page in English. Then you have to sign it. Then you go on to the next page. So it's a mindset that they've lived with for so long that it's going to take a while to turn it around. Mainland Europe is a bit of a mess. I'm actually quite hopeful about the UK. I think the UK has a lot of world-class companies, something like only 15 or 20% of all the revenue generated by UK companies actually come from the UK. The rest comes from around the world. And so they've been forced to be fairly competitive. You've got a lot of world-class companies there in the energy sector that have been beaten up. In the pharmaceutical sector, you've got some world-class packaging companies based in Ireland. So look, I think they're better ideas. In a global portfolio, if you look outside the United States, I'd say the UK and Japan are probably the two markets that are the cheapest with the greatest amount of potential. I think Europe is cheap, but Europe ex-UK is cheap, but it doesn't have the same amount of potential.
The only trade that seems doable still in Europe appears to be the defense stocks. Although that's getting more expensive.
Yeah, but they've run. I've been looking at those. I went to presentations, 2 years ago and again last year in Paris by some of these manufacturers. And they definitely need to spend money. I mean, people are waking up to the fact that, the United States is not going to only come to their defense, but maybe a lot of this American equipment that they have for their defense can actually be controlled by the Americans. There's this theory that maybe a lot of the equipment has cutoff switches or, and even some of the nuclear arsenal in the UK is all maintained by the Americans. So I think there's an enormous amount of money that needs to be spent in that area. Generally, money flows tend to drive returns, but those stocks seem like they run ahead of themselves a bit.
In the US, we've talked about some of the sectors in the US. What's interesting for you there? Or are you trying to avoid the US because the dollar has to weaken, stuff like that? How are you thinking through the US? Because it's been so dominant for so many people.
Yeah, America's now what, 75% of the world index?
It's incredible,
And
right?
yeah. And in a global equity long only portfolio, I have 20%, which people think is crazy. In a hedge fund, I have 10% because I can short out some things as well. And people think that's crazy as well. It kind of reminds me of Japan. In the late 1980s, Japan represented 60% of the EFA index. I used to run the Templeton Foreign Fund. At one point, I went to zero in Japan, and it was 60% of the index that I was compared to.
Wow.
And people said, that's ridiculous. You're taking an enormous amount of risk. My response is, you're taking an enormous amount of risk. You're putting 40% of your portfolio in a market you know is expensive only because it represents 60% of the index you're compared to. And I think that's the same case in America today. Nobody wants to underweight America. America is overvalued. America is historically overvalued. America is a phenomenal place, but everything has a price. And the amount of technology names trading over 10 times revenues today is just higher than it was during the peak of the bubble in 2000. And the market in America could fall 40%. It still wouldn't be cheap. It would be closer to fairly valued than cheap. So I don't think people understand the potential downside in the U.S. market.
The crypto community is divided over whether XRP's drop to $2 signals the end of its bull cycle or a promising buying opportunity. The token has fallen 40% from its multi-year high of $3.40, increasing volatility and trader caution. XRP appears to be consolidating, with price movement tightening and direction uncertain. Technically, bearish indicators are warning. Analysts say XRP's failure to reclaim levels above $2.20 suggests selling pressure will drag the price down toward a critical support zone near $1.77. This level could accelerate declines or give buyers a chance to defend long-term bullish momentum. Despite this caution, some analysts are optimistic. Experts like Stellar Babe believe XRP may be forming a bullish flag pattern, which usually precedes a strong upward breakout. XRP could reach $12, a 450% gain from current levels, if it breaks resistance at $3.21. Others point to the token's behavior within a 5-year ascending channel, which has historically led to significant rallies when key support levels are respected. Many consider XRP's 50-day exponential moving average a key technical line separating bullish and bearish momentum. A successful defense of this moving average could signal a reversal and revive gains towards $6.50. XRP's story is compelling beyond the charts due to its SEC legal drama and potential for cross-border payments. Technical traders and fundamental analysts continue to watch XRP as investors weigh short-term volatility against long-term utility and adoption. With sentiment divided and key technical levels in play, the coming weeks could determine XRP's next major move. Thanks for watching, and as always, stay curious, stay sharp, and we'll catch you in the next one.